Alright folks, here's a bit of a primer before we get into these plays. So this from Business Insider. Wall Street warns the banking turmoil is coming for the commercial real estate sector. Duh! The bank turmoil we saw in March feels like some time ago, but top strategists are warning that more consequences are still ahead, as we've already shown you. Regional banks' recent troubles are just the beginning. At least that's what a chorus of Wall Street folks have been saying this week. JP Morgan asset manager Jonathan Liang said Wednesday on Bloomberg that smaller banks now face an increased risk of credit loss because of their heightened exposure to the commercial real estate debt. Nearly $450 billion in commercial mortgages are due to mature this year, with final payments due in the coming months for many property owners, according to TREP data cited by JP Morgan. See, we've already shown you some of those properties. We think the story in banking is not over yet, Liang said. And Goldman Sachs Global Head of Real Estate Client Solutions, Jeffrey Fine, recently said the commercial real estate market is in the middle of a perfect storm of higher rates, tight credit, and fast maturing debt. Remember that balloon payment we saw? It's coming, fellas. The market faces a big rising that must be confronted, Fine said on Goldman's podcast, and anticipates a drop in valuations in older properties and office buildings. All right, folks, so we're going to check out options that are going to be reflective of the earnings in the second quarter. So what we want to do is we want to look at July, because, of course, you got April, May, June. That's going to be the second quarter. So June, end of June is when the cutoff is going to be. So you want to look at something in the month after in terms of the options, because as those earnings start to drop, you're going to see how good or bad the REIT or the bank did. So obviously with the information that I've been presenting you, we're building a case that it's not going to be pretty, right? So some of those loan defaults are going to start processing and going through the system over the next couple of months, because we're still, of course, in April. So we've got a few months for those things to play out and see how it affects the market. But stay tuned. All right, folks, and here's a look at some of those commercial office REITs via Benzinga. Now, while this may not be an exhaustive list of all the REITs that are available that are office driven, here's probably most of them right here, as you can see. Now, I won't go through each and every one of these right here. I will put the link in the description so that you can see for yourself, but we will take a look and see what it looks like to go with a put option on some of these. All right, you guys, so we're going to look at two. We're going to look at one REIT and we're going to look at one bank. Now, of course, you can take the time and go through these on your own, but I just want to give you just an example. So I didn't choose these for any particular reason. Just pick two that are be fairly popular and known in terms of in the space, but there's no particular reason why I chose these. Just because I chose these doesn't mean that, oh yeah, these are the best picks. Haven't had time to really go through all of it in an exhaustive form, but of course you can do that due diligence and research on your own, and I'm sure you guys might even have some feedback in the comments. So do leave feedback in the comments if you find something that's glaring or that's really a standout reason why one may be a better option to go ahead, no pun intended, a better option to go ahead and get some puts on. But we're going to look at Boston Properties, and we're just going to look at it on a monthly scale. So as you can see right now, it's at $52.28, and it has had a significant drop from about $132 right around there to where it's at now. So it could definitely go down further, obviously, because it's been there before, right? So we looking at that price entry. Remember, this is a monthly scale, right? So this goes back all the way to 1998. But let's go ahead and look at that option. Okay, so what we're going to do is look at July. And we've got it here on July 21st of 2023. So you see that's 91 days out. And we're looking at the ask on the put side. Okay. Now remember, so let's just say it's right here at $52.62 right now. Let's just say we believe this thing can hit $30 or less, right? So that's a pretty significant jump. Now, remember, option contracts represent 100 shares, right? So this ask that you see right here, that's the ask. That's the cost that it will cost us to buy this option. So when you look at that, that's 50 cents, right? So what we got to do is we got to multiply that times 100, okay? So when we look at this, let's go ahead and pull this up. I don't want to look at that one. All right, so there. So here's the option. So a $30 strike price put for July 21st of this year. So that's July 21st, 2023, $30 strike price put. Okay, so our break even, as you can see, is $29.49. Okay, that's the price that stock would have to hit for us to break even. Now, we can come down here where it says performance profile. Now we're looking at max loss. Okay, so max loss is $51. Okay, that's basically the price of the option, right? So that's your maximum that you could lose in this. This is not a margin, it's not leverage, it's just straight up. Okay, your break even again is $29.49. Okay, for the stock to hit $29.49, that's where you will break even on this option. Your max return would be $2,949. Okay, essentially that means that stock would go to zero. All right. So not only are we going to just look at the opportunity to make money when the market goes down in REITs, why not look at the banks that actually fund the paper to go with these REITs? We'll look at this article right here. Commercial real estate loans may add to woes for troubled regional banks. Commercial real estate loan defaults have risen to 14-year highs. Sizable exposure to commercial real estate loans could add to woes of regional banks, already struggling with unrealized losses due to rising interest rates as defaults on such debt climbs to 14-year highs. Lending for commercial real estate represents 18% of all loans listed as assets on bank balance sheets. That's a huge number. At regional banks, according to a recent report from Wedbush Securities. That's based on the median exposure of 9 publicly traded regional institutions. Regional lenders with the most commercial real estate loan exposure relative to their total loans include M&T Bank, Comerica Bank, and Zion Bancorp. At a group of 27 smaller mid-sized banks, commercial real estate accounted for 44% of total loan portfolios based on median exposure. Such loans accounted for more than 2/3 of total loans at 8 of those banks. New York Community Bank Corp., which recently bought assets of Silicon Valley Bank, that might have been a mistake, has commercial real estate loan exposure to the tune of 71% of its entire loan book. 71%? Are you nuts? Other notable names on the list include East West Bancorp with 39%, Signature Bank with 43%, PacWest Bancorp and Western Alliance with 28%, and First Republic Bank with 20%. The figures mirror an estimate by Fitch Ratings that found commercial real estate loans account for 1/3 of the loans at small banks with assets of $1 billion to $10 billion, compared with just 6% with banks with assets of more than $250 billion. In addition, Goldman Sachs estimates small to mid-sized banks account for 80% of all commercial mortgage loans. Here's a look at commercial real estate loan exposure at some regional U.S. banks that have been feeling the heat from the recent turmoil. So as you can see, look at this list. Recognize any names on here? So we're going to look at a few of those and see what would put options look like for these plays. All right, so we looked at a office REIT. Now we're going to look at one of the banks that would potentially be a funder for some of these outstanding REITs, right? So let's look at New York, New York Community Bank. Pull them up. And again, this is a monthly time frame. So as you can see now, it's currently at $9.13, and it's been a pretty precipitous drop since what is this? Going back all the way to like 2004. It pretty much has been in a down spiral. Hasn't really done very well for its investors. And you got this huge wick. Now I kind of start to get happy when I see huge wicks like that, because a lot of times when you see a wick like that, that wick tends to fill. Okay, but again, this is just for information and educational purposes only. There's no guarantee that it'll continue and fill that wick, but it is obviously a possibility. But we just want to take a look at these things. So let's pull up an option for New York Community Bank Corp. And we're going to pull up that option, and we're going to look at July again. So as you can see, it's at $9.17 right here in the middle. That's the current price, okay? So these prices that you see in the middle, those are the strike prices. Now, let's just say we're going to go for a cheapie. Let's go for $6. So we believe it's going to hit $6, okay? Going down $6, going down to $6. Now, as you can see, this will be a July 21st, 2023, $6 strike price put, okay? As you can see down here, so the max loss would be $10, essentially your cost for the option. Your break even would mean that the stock price would have to go down to $5.90. Okay, that's your break even, right? Means you wouldn't make any money, wouldn't lose any money. Your max return would be $590, right? So think about that. That wouldn't be bad if you could make $590, all right, off of a $10 option, right? So it's possible, right? If it goes to zero, that's essentially what you would get, right? Now, it doesn't have to go to zero for you to make money, but that's just the maximum amount of money that you can make, all right? So I hope this kind of helps you guys out in terms of ideas on making money when the market goes down. All right, you guys, so that's going to conclude part 2. And while this is not an overall exhaustive view of options, this is really just to get you familiar with some things. Definitely got to do some more research on your own for that. There's, like I said, there's tons of videos, excuse me, on YouTube and websites that can teach you more about options, but just trying to give you kind of a rudimentary, straightforward point of view on it. There's other things that you need to understand, and theta and Vega and Beta and all that other stuff that helps you understand the pricing of options. There's actually option apps that can calculate a lot of the variables out for you. But we want to try and keep it simple because we don't want to overthink and overcomplicate things, right? So, you know, if you got a few bucks that you could put on a play and you're just tired of only being told how to make money when the market goes up, try these put options out for size. All right.